Welcome to the deep dive. There's just so much information flying around every single day.
There really is. It's hard to keep up.
Exactly. So today, we're going to sift through your latest stack of sources. We'll pull out the key insights, the surprising bits on market movers, corporate stories, global shifts.
Right. The goal is to give you that clear shortcut so you feel informed without, getting totally overwhelmed.
We've got a lot to cover. Tech stocks doing their usual roller coaster thing, some big earnings reports, the Fed trying to figure out what to do next.
Always a balancing act there.
And of course, those geopolitical currents that just keep shifting things around.
It's a really diverse landscape we're looking at today.
Okay, so let's dive right into markets. Wednesday, August 20th. It felt pretty mixed out there.
Yeah, definitely mixed signals.
The S&P 500 and the NASDAQ, they both finished lower again. That's 4 straight down days for the S&P, second for the NASDAQ.
But the Dow actually managed a tiny gain. Fractional, but still green.
So what's going on there? What's driving that split?
Well, it really looks like classic profit-taking. Yeah. Especially in those big tech and semiconductor names that have just run so far so fast.
Oh.
People are starting to get a little nervous about the valuations,
Yeah.
and maybe questioning how long this whole AI boom can keep lifting everything.
Right.
We saw NVIDIA, AMD, Broadcom, Palantir, even Intel. They were all down today.
But it's interesting. The S&P 500, despite that tech drag, it actually found some footing.
It did. Right around its 21-day moving average.
Which is a key technical level, isn't it? Like a line in the sand for traders.
Exactly. And the Dow, like you said, it held up better because money was flowing into more defensive areas, financials, healthcare.
So does that mean the broader market is still kind of healthy underneath, or is it just investors running for cover temporarily?
It definitely points to a rotation happening. And you're right about those moving averages being watched closely. Look at the semiconductor ETF, SMH.
Okay.
It had a pretty nice bounce off its 50-day line.
Yeah.
So some buyers stepped in there.
But not everywhere in tech.
No, definitely not. The software ETF, IGV, that's a much tougher picture. It did bounce off the day's lows, sure, but it's got a lot of, let's say, repair work to do. The selling pressure, the downside volume has been really heavy there, much weaker than the chip sector.
And this tech weakness really hit some individual stocks hard.
Yeah.
Palantir, PLTR, I mean, wow.
Yeah, that was dramatic. Mother of all shakeouts, as one source put it.
Down nearly 10% at one point today, pushing it into correction territory.
Its longest losing streak since, April 2024, now down 18% from its recent high.
And it actually fell out of the top 20 most valuable U.S. companies. That's quite a tumble.
It is. And what's really interesting here is the why. You had that short seller report from Citron Research calling it detached from fundamentals.
Right, the valuation argument again.
Exactly. But then you have other analysts like Dan Ives saying, hey, this sell-off, it's a buying opportunity.
So a real split opinion.
It really forces you, the investor, to think hard. How do you tell the real AI leaders, the ones with sustainable growth, from the ones that maybe just got caught up in the hype, whose valuations got way ahead of themselves?
And Palantir wasn't the only one struggling. Intel, INTC, slid almost 7% today.
Yeah, that was another notable drop.
Which is interesting because there was news about SoftBank putting $2 billion into Intel. You'd think that would help.
You would think.
Yeah.
But then you have these other reports swirling that the Trump administration might be thinking about taking actual equity stakes in chip companies that get HPK Act money.
Equity stakes, like the government owning part of Intel or Micron?
Potentially.
Yeah.
And that seems to be casting a pretty big shadow. It's putting pressure on stocks like Intel and Micron.
That sounds pretty worrisome for the chip makers.
It really is.
Yeah.
Because it adds this whole new layer of uncertainty, right?
Yeah.
Even if a company seems solid or gets a big investment, this kind of potential government intervention, it's unpredictable. It just shows how policy shifts can really move markets, maybe even more than the company's actual performance sometimes.
Okay, so while tech is churning, we're seeing money move elsewhere into those defensive sectors.
Exactly. Boston Scientific, for example, ticker BSX. It made a pretty bullish move today.
How so?
It broke nicely above a recent downtrend line on its chart, a positive technical signal.
Ah, interesting.
And it fits that pattern we mentioned. Healthcare stocks, insurance companies like Travelers or the key insurance ETF, they're attracting interest.
Because they're seen as safer.
Pretty much. They're classic defensive plays. Their business is usually less tied to the ups and downs of the economy. So in a choppy market like this, investors kind of gravitate towards that stability.
Even if the growth isn't maybe as exciting as tech?
Right. Sometimes predictability is what you want, even if the growth outlook is, let's say, a bit spottier.
And for income seekers, I saw Sabra Healthcare mention. That's a REIT, a real estate investment trust.
Yep, ticker SBRA. Another defensive idea, and it comes with a pretty nifty dividend yield, north of 6%.
That's attractive. Are REITs generally doing well?
Well, the appeal isn't just U.S.-based. Look at the U.K. market. REIT valuations there got, frankly, ridiculously low.
Making them take over targets.
Exactly. And there was this interesting situation with Primary Health Properties, PHP, fighting off a bid from KKR for another REIT called Assura.
Okay.
What was fascinating was that Assura shareholders chose to keep their shares in the combined company instead of taking KKR's cash.
What does that tell you?
It signals they believe these companies, even at low valuations, can actually build real scale in specialized areas like healthcare properties or student housing.
I see.
And that sticking with the company offers better long-term value and maybe more liquidity down the road than just cashing out now. It's a vote of confidence, really.
Okay, let's pivot to some specific company earnings and performance. Some good news first. Analog Devices, ADI.
Yes, they had a strong Q3 report. Beat expectations on both earnings and revenue.
EPS $2.05 versus $1.93 expected. Revenue $2.88 billion versus $2.79 billion. And that's what, their fourth beat in a row?
It is. Consistent performance. And their Q4 outlook looks solid, too. Forecasting around $3 billion in revenue and EPS near $2.22.
What's driving that strength?
They're seeing double-digit growth compared to last year across all their end markets.
Wow.
So it points to really broad, robust demand in semiconductors, even with all the global trade uncertainty swirling around.
That's impressive.
Plus, they're returning a lot of cash to shareholders. $1.6 billion just in Q3 through dividends and buybacks. That says a lot about their financial health.
Now, on the other side of the coin, Target, ticker TGT. Sounds like they're really facing some major headwinds.
Yeah, it's a much tougher story there. Declining sales, fewer customers coming through the doors, and those who do come are spending less.
The stock dropped over 6% today, and the market cap, what, $45 billion? Down from $129 billion in 2021. That's a huge drop.
It really is. And the market reaction to the new CEO appointment? Oh, it's pretty chilly.
Michael Fidelk, promoted from COO, right?
Right. It seems investors were hoping for an outsider, someone to bring a totally fresh perspective.
So what's hurting them so much? Is it just the economy?
That's part of it, for sure. Post-pandemic spending shifts, high inflation hitting budgets, Trump's tariffs adding costs.
And not just that.
No, sources point to self-inflicted wounds, too. Things like subpar experiences because stores feel understaffed, and maybe a perception they've backed away from some of their earlier diversity initiatives, which alienated some customers. They seem to have lost some of that unique Target appeal, that feeling it was a bit more special than other big box stores.
Right.
And that partnership with Ulta ending next August, that's another blow. It was seen as a key traffic driver.
But it wasn't all doom and gloom in retail. Let's talk about Pop Mart, this Chinese toy maker.
Ah, yes, the ugly cute dolls. Labubu.
Their shares spiked over 12% today. Why?
Get this. Nearly a 400% surge in net profit for the first half of 2025.
Wow. 400%.
Yeah, driven by massive global demand for those dolls. Revenue jumped over 200%. The CEO's talking about potentially $20 to $30 billion yuan in revenue for the full year.
That's incredible growth. Is it sustainable?
Well, that's the big question, isn't it? The stock's been pretty choppy. You've got short sellers betting against it, some domestic investors taking profits. And the underlying concern is always about the longevity. Can they keep churning out hit characters? Is this just a fad, or can they build lasting intellectual property? Investors are definitely wrestling with that one.
Okay, let's quickly run through a few others. Lowe's, the home improvement retailer.
Yeah, they beat their Q2 earnings estimates.
And they announced a big acquisition, Foundation Building Materials, for $8.8 billion.
Right. A strategic move to bolster their pro business. Their stock was up today.
Seems like home improvement is holding up okay then.
Reasonably well, yeah. Especially with that acquisition signaling longer-term confidence.
But Estee Lauder, the cosmetics giant.
Different story there. Stock slipped about 7%.
Why was that?
Their guidance for fiscal 2026 was disappointing. And they specifically called out a $100 million hit from tariffs.
A direct impact from that policy we discussed.
Exactly. Tangible impact right on the bottom line.
Hertz, the car rental company, saw its shares jump, though.
Yeah, that was interesting. They announced a partnership with Amazon Autos
to sell used cars.
Precisely. A new channel to move their inventory. Seems like a smart move.
And Baidu, the Chinese tech company.
Kind of mixed results there. They beat earnings expectations, but missed on revenue.
And the market focused on the revenue miss.
It seems so. The stock dropped nearly 2%. In tech right now, it feels like revenue growth is really what investors want to see, maybe even more than just the bottom line profit.
Finally, in financials, JP Morgan Chase is buying Goldman Sachs' Apple Card portfolio.
Yeah, that deal was confirmed, described as a win-win.
How so?
Well, for JP Morgan, it's a huge boost to their credit card business, right? Millions of new, generally high-quality, tech-savvy customers.
Right.
And for Goldman, it lets them exit a consumer lending business that maybe never quite fit their core strengths in investment banking and trading.
So a strategic refocus for both.
Exactly. A clean way for both to double down on what they do best.
Okay, let's shift gears to the Fed, tariffs, inflation. It feels like a really tense crossroads right now.
It really does. So much uncertainty.
We just got the minutes from the July Federal Reserve meeting,
Yeah.
and they revealed a pretty significant split, didn't they?
A real divergence of opinion, yeah.
Yeah.
They kept rates steady, as expected.
Yeah.
But two Fed governors, Christopher Waller and Michelle Bowman, actually dissented. They wanted a rate cut.
Wow. That's unusual, isn't it? Multiple dissents.
First time since 1993, according to the sources. It really highlights that tension within the Fed's mandate.
The dual mandate, inflation versus employment.
Exactly. You've got the upside risk to inflation versus the downside risk to employment. Most Fed officials seem more worried about inflation sticking around, but the dissenters, Waller and Bowman, were clearly worried about the job market weakening.
And you can see why, right? That last jobs report.
Yeah, July non-farm payrolls only added 73,000 jobs, and they revised May and June, way down a combined 260,000 jobs just disappeared from previous estimates. That's significant.
So given that weak jobs data and the dissents, here's where it gets really interesting. The market is now pricing in a huge chance of a rate cut in September.
Yeah, CME's FedWatch tool is showing, what, like an 84.9% probability?
Almost 85%. That seems incredibly high. How much attention will Powell pay to that market expectation when he speaks at Jackson Hole?
That's the million-dollar question, isn't it? His keynote address on Friday is going to be absolutely critical. Everyone will be parsing his work.
Looking for clues.
Exactly. How does he talk about the risk assessments? How much policy flexibility does he signal? That will tell us a lot about their thinking, short-term and maybe longer-term.
And if he sounds hawkish, worried about inflation still.
That could definitely put more pressure back on stocks, especially tech. But if he hints they're open to cutting soon, well, that could soothe the market's nerves.
And adding another layer of complexity here is, well, the Trump factor.
Right. The political pressure on the Fed is intense.
President Trump has been very vocal, criticizing Chair Powell, pushing hard for rate cuts.
And it's not just Powell anymore. Trump has now publicly called for the resignation of another Fed governor, Lisa Cook.
Really? Based on what?
Based on claims made by FHFA Director Bill Poult, alleging mortgage fraud.
Mortgage fraud. What are the specifics?
Poult alleges she falsified documents, property records, essentially claiming two primary residences at the same time to get better loan terms.
Wow. That's a serious allegation.
It is. And whether it's true or not, the fact that Trump is making these kinds of demands, it shows he's widening his attacks beyond just the Fed chair. It's pressure on the institution itself.
Which adds another layer of political risk to everything the Fed does.
Absolutely.
And beyond just pressuring the Fed, Trump's policies are having direct economic effects, right? Those tariffs.
Yes, the steel and aluminum tariffs have been expanded. Now there's a 50% charge on hundreds of additional products. Things like fire extinguishers, various types of machinery, construction materials. It's a broad list.
And the impact.
Well, it risks exacerbating those supply-side shocks we've talked about. It could potentially reignite inflation by making imports more expensive.
Right.
And it definitely adds costs for businesses. We just heard Estee Lauder mention a $100 million hit to their profits, specifically because of tariffs.
So it's not theoretical. It's hitting company bottom lines right now.
Precisely. It's a real-world cost.
Now, you mentioned inflation. Let's do a quick look back. I saw a source referencing late 2021, something about used car prices.
Ah, yeah, Jim Bianco's warning back then. It's a fascinating little historical snapshot.
What was happening?
The Manheim Index, which tracks used car prices, was just skyrocketing. It was actually rising faster than Bitcoin and the S&P 500 at that moment.
Faster than Bitcoin. Wow.
Yeah, up over 20% in just 4 months. Bianco called it bubblicious and a telltale sign of a bubble.
What caused it?
It was Partly the shortage of new cars because of the semiconductor crunch, but also just pure speculation, people buying used cars hoping to flip them.
Mm.
And Bianco's point was that this reflected a self-reinforcing idea about inflation, taking hold, exactly the kind of thing the Fed didn't want to see.
So what's the lesson looking back at that?
It raises a good question for today, doesn't it? What seemingly niche or unusual market movements now might be acting as that canary in the coal mine? What could be signaling broader economic shifts or inflation dynamics that maybe aren't getting enough attention?
Let's shift focus to the global stage now. Energy, geopolitics, trade, always interconnected, starting with big oil and their big bets on LNG, liquefied natural gas.
Yeah, companies like Shell, Total Energies, BP, Exxon, Chevron, they are all pouring serious money into LNG projects.
But isn't the forecast for gas demand kind of flattening out? I thought the IEA, the International Energy Agency, predicted demand might peak by the end of the decade.
That's exactly the conflict. The IEA is cautious, but companies like Shell are incredibly bullish. Shell sees LNG demand growing 60% by 2040.
60%. Where do they see that demand coming from?
Mostly economic growth in Asia, industry switching from coal to gas to cut emissions, and interestingly, the AI boom.
AI needing more energy for data centers.
Exactly, driving up electricity demand, which LNG could help meet. But critics are definitely pushing back.
Saying it's risky.
Yeah, calling it a risky bet against the clean energy transition, especially with concerns about methane leaks from the gas supply chain. Plus, the IEA itself thinks there could be an LNG supply glut, too much supply, by 2026.
So a real disagreement on the future there.
A huge one. It shows how committed these energy giants still are to fossil fuels, really betting on massive emerging market demand and new drivers like AI, even as climate pressures mount.
And tied into energy security, you have geopolitics, especially around the Strait of Hormuz.
Absolutely critical. Any disruption there poses a huge risk to oil and gas supplies, particularly for big Asian importers like Japan, South Korea, China, India.
Adds another layer of risk to those LNG bets.
For sure. And it feeds into this wider uncertainty we see in the oil market forecast, too. The OPEC-IEA demand divide.
Meaning they disagree on how much oil the world will need.
Significantly. For 2025, their global oil demand growth estimates are miles apart. The IEA keeps trimming its forecasts, often pointing to China's demand not quite meeting expectations.
Okay.
OPEC, on the other hand, sees a much tighter market, much stronger demand. It leaves the market completely guessing about supply and demand balances next year.
And trade tensions are simmering too. I saw Peter Navarro, the Trump advisor, had some strong words for India.
Yes, basically calling on India to stop buying Russian crude oil. He labeled it opportunistic and said it undermines efforts to isolate Russia economically.
How is India responding?
Their argument is that it's a necessity. They need affordable energy for their economy and population, and given the global market situation, Russian oil has been cheaper. It's a tightrope walk for them.
And the U.S. reaction?
The Trump administration slapped an additional 25% tariff on India, specifically over these purchases. That brings the total levies up to 50%.
Wow. So energy, trade, geopolitics, all tangled up.
Completely intertwined, decisions in one area ripple straight into the others.
Meanwhile, on the diplomatic front for Ukraine, President Trump met with President Zelensky.
Yes, along with European leaders at the White House. Trump made a statement saying Zelensky can end the war with Russia almost immediately.
How did markets react to that?
Interestingly, European defense stocks actually extended their losses today.
Because it's hopes for a ceasefire?
It seems so. Any hint of peace, even just a statement, tends to hit defense stocks. They thrive more on conflict and uncertainty.
Shifting to the Middle East, the situation in Gaza sounds like it's escalating.
Yes. Reports say Israel has begun the first stages of a planned assault on Gaza City. They've called up 60,000 reservists.
What are their stated objectives?
To intensify strikes against Hamas, while also warning civilians to evacuate southern areas and saying they'll expand humanitarian aid corridors.
But there's international opposition and a ceasefire proposal.
Right. Opposition is growing. And Hamas apparently accepted an Arab-backed proposal for a 60-day ceasefire and hostage release.
But Israel isn't accepting it.
It seems they're largely ignoring it for now, pressing ahead with the military operation. And adding to the complexity, Israel also just approved a new settlement in the West Bank.
Which could complicate things further.
Definitely. Critics say it could imperil a Palestinian state. So you have the immediate conflict escalating, a huge humanitarian crisis, and actions that undermine longer-term peace prospects all happening at once.
Okay, let's look quickly at Asian markets more broadly. Mixed performance today.
Yeah, pretty mixed. One notable data point was Japan's exports. They plunged 2.6% in July.
That's a big drop.
Steepest in over 4 years, actually. A sign of slowing global demand, perhaps.
And China. What's happening there?
Well, China kept its main lending rates unchanged again for the third month in a row.
Despite the weak economy.
Exactly. The macroeconomic data hasn't been great. But here's the puzzle. Chinese stock markets have been, well, kind of on fire lately.
Really? Why?
It seems to be driven by just tons of liquidity sloshing around, combined with those low interest rates. Equities just look like the most appealing place for Chinese households to put their money right now.
So the market is sort of defying the fundamentals.
For now, yes. And the big question is, how long can that last? Can monetary policy alone keep propping things up without a real pickup in the underlying economy?
And briefly, Thailand.
Yeah, the Thai market is expected to sort of tread water or rebase as investors there also watch Jackson Hole and keep an eye on those Russia-Ukraine peace talk signals. Shows how globally connected everything is.
Okay, let's bring it back home to U.S. domestic policy. These shifts can hit just as close, if not closer. FEMA, the Federal Emergency Management Agency. Sounds like changes are happening there.
Yes, the Trump administration is apparently reshaping FEMA with the goal of giving out less money directly from the president's office for disaster relief.
Less money, so who picks up the slack?
State and local governments would have to bear more of the financial burden for recovery.
Can you give an example?
Well, look at Hurricane Helene in North Carolina back in September 2024. It caused nearly $60 billion in damage.
$60 billion, that's huge.
It is. And so far, only about $3.7 billion in federal aid has actually been paid out.
Wow, that's a big gap.
It is. And critics are already saying FEMA is too slow to pay victims. They worry that cutting federal funding further, especially with climate change, potentially bringing more intense disasters, could lead to a colossal disaster in terms of recovery funding down the line.
So a potential major shift in who pays for disaster recovery.
A fundamental one, yeah. Redefining that federal versus local responsibility.
Now, on energy policy again, but domestically. Renewable energy, solar, and wind.
Right. President Trump made a pretty strong declaration. His administration will not approve new solar or wind power projects.
Not approve them at all. Why?
His criticism is that they take up too much land, and he blames them for rising electricity prices.
And has policy followed that statement?
It seems so. The administration has tightened up the federal permitting process for renewables, centralizing approval power with the Interior Secretary.
Okay.
And there's that proposed legislation, the One Big Beautiful Bill Act, which aims to kill the tax credits for wind and solar by the end of 2027.
And don't tariffs play a role here too?
They do. Those tariffs on steel and copper that we talked about, they also increase the construction costs for wind and solar projects.
So multiple levers being pulled to slow down renewables.
It appears to be a pretty deliberate strategy, yes, affecting permitting, financing, and material costs.
Okay, let's shift to personal finance for a moment. Home equity lines of credit, or HELOCs. Seeing more use of those?
Yeah, homeowners seem to be tapping into their home equity more often lately.
Yeah.
Using ELO keys for things like home renovations, maybe college tuition.
How exactly do they work again?
It's basically a revolving line of credit, like a credit card, but it's secured by your house.
Secured meaning?
Meaning the house is the collateral. Typically, you get a draw period, often 10 years, where you might only pay interest. Rates right now average around 8.13% on a typical $30,000 HELC.
Okay.
Then comes a repayment phase, often 20 years, where you pay back principal and interest.
So the rates are usually lower than, say, a personal loan or credit card?
Generally, yes, because it's secured. But that's the crucial part to remember.
The secured part.
Exactly. If you miss payments, the lender can actually foreclose on your home. So while it can be a useful tool, it comes with significant risk and responsibility.
And just one last item, a quick legal note. The Jeffrey Epstein case.
Right. A federal judge rejected the Trump administration's request to unseal the grand jury materials from that criminal case.
Why did the judge reject it?
The judge called the request basically a diversion.
A diversion.
Yeah, saying the government already has a huge amount of files related to the case that it could release directly if it wanted to. The judge pointed out it was a reversal from the administration's previous promises about disclosure.
So highlighting a tension around transparency in that case.
Exactly. A push and pull over what information becomes public.
All right. So we have covered a lot of ground today. That volatile dance in the markets, tech driving things,
The ups and downs of big companies like Target and Analog Devices.
the Fed doing its tightrope walk on rates with all that political pressure and the tariff impacts.
Yeah, and that complex global picture, energy security, trade fights, geopolitical hotspots.
It really underscores how interconnected everything is, doesn't it?
Absolutely. You pull one thread, a corporate report, a policy decision, a conflict somewhere, and it just ripples through the whole global economy, often in ways you don't immediately expect.
So for you listening, the learner, trying to make sense of this information fire hose, what does it all mean?
Yeah, with so many different, sometimes conflicting signals hitting us all at once. How do you even begin to prepare for what might come next?
Is the answer finding safety in those defensive stocks we talked about? Or trying to time the next big tech wave?
Or maybe it's about looking deeper, understanding those underlying currents of global policy, trade disputes, conflicts, the things that are really shaping the landscape.
It's something to think about. How do all these seemingly separate pieces, market moves, earnings, Fed speak, tariffs, global tensions, how might they actually fit together to paint a bigger picture, even if it's a really complex one?
Right. And what patterns can we maybe start to see in that picture that might help us anticipate the next shifts in our, well, rapidly evolving world? Food for thought.